The financial system facilitates the allocation of savings and investment in the economy. Savings will denote as an S, and investment, obviously, we've discussed as an I here. And what we want to consider here is national accounting in terms of output. We know that output is GDP. This is gross domestic product. And we know that GDP, or output, we've denoted as a Y, and that there are four main components of gross domestic product. There's consumption, C. There's I, investment. These are the things that businesses would purchase, kind of capital investments that they would make in machinery or in businesses and facilities. Government expenditures, so this is the spending that the government has on its citizens. It taxes and takes in money, and then it spends some of that money on welfare programs or on roads and development, things of that nature. And then we've got net exports here, exports minus imports, and exports we know add to an economy's GDP because it is they are goods that are created here domestically but purchased abroad, whereas imports, they take away from GDP, or in essence we net them out because these are goods that are produced abroad. They are produced by foreign companies or foreign individuals, and they might be purchased here domestically, but we also net them out because it did not take place, that production of output did not take place within the borders of the country. This is often discussed as like net exports as well. So sometimes you see it as NX. There's two ways in economics that we treat net exports: if a country is open to trade or if a country is not open to trade. And so let's just kind of do that here. We can say if a country is open to trade, this is a country that would be called in an open economy. Open economy. And net exports would exist. There's a simplification that we make in a lot of cases to kind of consider national accounting and really take a number of the issues that happen with trade out of the equation, such as exchange rates and a number of kind of trade barriers and tariffs and things of that nature. So whereas you could have a country that is open to trade, we could also have a country that is closed to trade. Closed to trade. That it sends nothing to other countries, that no other countries send anything to that country. And in this simplified version, we would call this a closed economy. Closed economy here. And I put these because you will often come across this in economics textbooks where you will see it listed out, and all that they're discussing is in a closed economy, net exports do not exist. You would just have three components of GDP, of domestic output, and that would be consumption, investment, and government spending. So in a closed economy, we have Y, output is equal to consumption plus investments by firms or household purchases of housing, and government expenditures. If we rearrange this, we can rearrange this in another direction, and I want to solve for investment here. And if we do that, we would have investment is equal to total output, GDP, minus consumption, right? Minus government expenditures. And this is one of the things that we call this national savings. National savings here. And national savings is what happens when what is it? It is all the income in the economy after paying for all the consumption in the economy and all the government spending, government expenditures in the economy. We were talking up here about how the financial system allocates savings and investment, and there's an important identity that we have in economics here, which is that investment is equal to savings within a given time period for the economy. And that would be true if you kind of think about it. What is investment and savings? If you are an individual saver, if you save your money in the most simplistic case, what happens? Well, you can invest your money in stocks or bonds, or more likely, you put your money into a savings account. And what does the bank do? Well, it turns around and it takes that money in the savings account and it loans it out to other individuals who are buying homes, or it loans it out to businesses that are trying to buy capital to help grow their business, to buy new machinery or buy new computers or buy new cars for their sales employees, things of that nature to make them more productive. And then what do you get? Well, you get some sort of interest rate on those loans in your savings account for the right for them to be able to loan out that money. And you can come back into the bank and take your money at any given time. And so national savings, in the most simplistic case, the investment in our economy is financed by how much we save. And so this is an important identity because it really kind of drives investment and savings within the economy. There's another way that we can write this so that you will often see this. I'm going to write it in terms of savings. Savings is equal to, and I'm going to write this in a different way because one of the ways I want to consider is what is this government spending here? Government expenditures. Well, what does the government do? It takes in taxes, right? And then it spends. And it spends that money on individuals, on welfare, on building roads, on education, on any number of things that the government, on national defense, any number of things that the government might spend money that would count towards GDP on. Those taxes, when we think about taxes here, we know that in this case we want to simplify it in a certain way. We know that there's a certain amount of government expenditures that do not count towards GDP, and those are transfer payments. Payments like Social Security and welfare, or I'm sorry, Social Security and Medicare. So if we're going to think about taxes here, that we mean taxes. T is equal to taxes minus transfers. That those transfers would not exist in this GDP calculation. So if that is the case, then we can take this taxes and we can use that to kind of rearrange what G is here. Savings would be equal to total output in the economy minus taxes that are paid by individuals minus the consumption that individuals pay. In this portion, we would call this private savings. In private savings, this is what is left over after we take into account all the taxes that you have to pay the government and everything that you spend money on as a society for all the individuals. And then we would also kind of add, if we still need to take into account the government part of this, the government spending. And what is that? Well, we've already taken in the taxes, so here we would have the taxes as well to net that out minus government spending. And so this part over here, the government receives taxes from individuals, and then it spends money here. In the most simplistic case, right, we'll say that G is the government expenditures. And taxes minus government expenditures, this is public savings. Public savings here. Taxes, and we can think about this in a few different ways. And let me just kind of change the color here so that we don't get too confused. When taxes are greater than spending for the government, this would be a government that would be running a budget surplus. This would be a surplus. Because what are we talking about? This would be a case where they take in, let's say, $3 trillion, but they only spend $2.8 trillion. There would be money left over. That leftover money would be public savings. There's another case where taxes would be less than spending for the government. So the government takes in a certain amount of money, $3 trillion. However, it spends $3.5 trillion. Maybe it's a wartime and you're spending more money. This would be a case where we talk about a budget deficit. It is a deficit in a given year, in a given period of time for GDP. And in this case, the government deficit, this would have to be financed. That excess spending over the taxes that are collected would have to be financed. And that would be financed through open market activity, right? This is where we start talking about treasury bills, where you would buy bonds in the United States government that help finance the debt in the government. And so these two identities, right, all we're really doing is rearranging the formula for GDP and considering what's actually going on in these pieces. The most important things here is that that investment is equal to savings. And then here, as we think about, when we think about what are the two different types of savings within the economy, we've got private savings and we have public savings, and we thought a little bit about why those exist.